Okay, so let's take a look at the differences between variable and absorption costing. I'm going to be using a template. I have some data input areas here. And I'm going to go to the absorption area. And first thing I'm going to do is remove this because they are tied to the front page. So no entry points are required here. And that's the nice thing about a template. And then we're going to talk about variable and absorption comparison at the end. Okay, so real quick, let's just set this up. So units sold are going to be 20,000. And in our case, we're going to produce more than we sell in this instance. If we sold the exact same amount that we produced, then our net operating incomes would be the same between cost of goods sold. We might just take a quick look at that to see how that plays out. So our selling price is going to be $30 per unit. And we see that the sales amount is the same in both examples. And that's because sales doesn't come into play with variable and absorption costing. Only three things really come into play that move around. In other words, it's kind of like a moving target a little bit. Is inventory, right? Finished goods. Cost of goods sold, which is where finished goods goes to once it's sold. And operating income. Because inventory and cost of goods sold has an inverse relationship. Things are going to happen. And because cost of goods sold and inventory or operating income has an inverse relationship as well, it's going to be changing constantly with production volume and sales. So our units produced is 25,000. Our variable units per cost, which is our direct labor and materials, is $10. And that's it for now, okay? So that's just our variable costs. And you can see the variable costs are cranking up here. We have no other costs associated. This is variable costing, so we shouldn't see any kind of fixed component in the calculation of the inventory. So we're going to put in fixed manufacturing overheads, 150,000. And at that point, notice that the 150,000 populates under the contribution margin. And that's because all fixed costs go below contribution margin and is treated like a period expense. All right, now we're going to have a mixed cost. They always want to throw a mixed cost in. And it's important because a portion of that's variable, and variable expenses, even though it's not a production cost, still goes above the contribution margin. And we've got a fixed cost or mixed cost of $3 with a fixed cost associated with that $3 of $100,000. Right, at that point, we're done. Everything is done. So we can see we have variable costs. This is goods available for sale of 250,000 minus 50,000 of inventory that's remaining. That's 5,000 units at $10. And remember, we had $10 direct labor costs and direct materials costs. That gives us cost of goods sold of 200,000. Then we got other variable costs of 60, which is tied to our variable cost amount there. And then we get our contribution margin of 340,000. At this point, we can calculate break even, at least in terms of dollars. And then all of our fixed costs are suspended down here, and we end up with a net income or operating income of $90,000. Now, under absorption costing, it's all done. $600,000 in sales, $250,000 in variable costs, and there's that $150,000 in fixed manufacturing costs above the cost, up into the cost of goods sold, right? Because remember, that's the big ball. The big ball has direct materials, direct labor, and manufacturing overhead, fixed and variable, all going into finished goods. So that's absorption costing. That's the way we're used to seeing it. The goods available for sale in this case is 400,000, and our ending inventory is $80,000. All right, because we have 5,000 units we have 5,000 units of direct labor, $10 per, and then we have another $6, I believe it is, of fixed cost. So if we take that 150,000 divided by the 25,000 produced, we get the variable yeah, it's not really variable, but it's the cost per unit. And that's what is being carried in the inventory. So our other ending inventory was 50,000. Now it's 80,000. That's because we have some extra fixed costs up there in that big ball sitting in finished goods. Gives us cost of goods sold of 320,000 with a gross margin. Notice we call it a gross margin now and not a contribution margin because it's more like a gross profit. 280,000. Our variable period cost was $3 per item sold, and there's our variable or fixed period cost. And that was just what they called administrative operating, variable selling and administrative expenses. There's a mixed cost there involved. So notice, just real quick, when we have sales that's less than production, variable absorption costings, net operating income will be higher and lower. So if we just reverse that, it would just be the reverse. Now, it might not be 120 or 60, I don't know, but its variable cost is going to shift to more, absorption cost is going to shift to less. And it also, when we put in a beginning inventory, things can change a little bit. Now let's look at this comparison. This is called a reconciliation. So under absorption, our cost of goods sold was 320,000 and our ending inventory was 80. Just seen that. Under variable, our cost of goods sold is 200,000 and our ending inventory was 50,000. To reconcile these two, we take the operating income under variable costing and take the additional fixed manufacturing costs suspended in that big ball up in finished goods, and that has to equals 120,000, which is in fact equal to the absorption costing operating income. We just reconciled our variable costs to our absorption operating income, our variable operating income into our absorption costs operating income. So I hope you understand this. You know, I can't see your faces, so I think sometimes certainly you understood it. But if you don't, ask a question in the discussion board and we can talk more about it. So let's just play with this for a second. Okay, so let's make our sales equal to our units produced. Point, that changes our operating income to 175,000. Okay. Under absorption, it's 175,000. Remember, I told you that if production and sales are the same, the operating incomes are going to be the same as well. Now, I'm curious to see what my operating reconciliation is. That's right. The ending inventories are the same. The only thing different is the cost of goods sold, but the difference between variable and absorption costing is the fixed costs that go up into finished goods, and there are no differences. So therefore, we are reconciled. So that's pretty interesting. So again, we could just take a look real quick. You know what I'm going to do? I'm going to let you do this. I'm going to give you this template, and I'm going to leave it just like it is here. And then what I want you to do is put in 25,000 in units sold and 20,000 units produced. In other words, you sold more than you produced. Now, the only thing I can think of is that's probably going to require some beginning inventory. We haven't played around with the beginning inventory too much. So if I just put in a beginning inventory in there, probably would shift things around a little bit. So I want you to toy with this a little bit. I will do the same. And if I see anything that's really unique, I'll do another video. If you don't see another video, then it's up to you to figure that out. And so next, I'll be talking about target costing and cost plus pricing.